All right, so welcome to another video. In today's episode, what we're going to do is we're going to take a look at 4 tips on how to trade moving averages much more successfully. So if you've seen one of the other videos that we have on moving averages, then great, this will help out. This is kind of step 2 or another video. If you haven't, check out some of the other videos we have on our YouTube channel and website to learning to trade better with moving averages, technical indicators, and so on. Now, if you don't use moving averages already, I highly encourage you to check them out. But of course, at the end, remember the big picture behind the goal is to make sure that you're using it to trade better. It's not that there's any magic indicator or holy grail thing out there that's going to just all of a sudden make you more money. What you're doing is using these in context to be able to trade smarter and make better trading decisions. So here we have a moving averages. This is kind of a yellow line right here. And this yellow line smooths out this picture of prices. Now you have 2 different types of moving averages. This is an exponential moving average, but you could go ahead and do it as a regular smooth, simple moving average. So in order to do that, I'm going to go ahead and add this plot here, moving average, and we'll just do simple. And here is let's make it blue. I'm going to go with 55 and we'll make it nice and thick. So you can see the difference here is there is a subtle difference, but not too crazy. So the difference is really is the simple moving average just takes all of them, adds up, let's say the first day of 5-day moving average, divides by 5, it gets a value and it plots it. Second day, boom, takes it, divides it, plots it. So it'll be 13, 14, 15. Whereas an exponential gives like a weight multiplier. So here's kind of the formula, and it kind of smooths out the curve where the more recent prices are a little bit more important. Anyway, so what we've got going on here is I'm going to go ahead and remove that moving average, as we've got let's say a 100-day moving average right here, and I've got CVS right here. So you can see it's been going down from an average perspective. And the whole point behind an indicator is because there's so much busyness and clutter out there when it comes to trading. So what you're trying to do with these averages is smooth things out. So tip number 1 that I'm going to give you is that use moving averages for crossovers to see multiple trends. So this moving average, it'll give you, hey, is the stock above or below? And it gives you a trend, but it gives you only one trend or one perspective. It doesn't give you short duration and long duration. So what you can do is add another one. And what we can do is go to exponential moving average. I can add a second one here. And let's say I add a 21-day, and I'll go to make this color a little bit more blue. Let's do like a 50-day, actually. Why not? Okay, so what you'll see is where are things crossing over, or where are things where the short duration, because we have now a 50-day moving average, and we have a 100-day or 100 bar, and you see where it crosses. And the point that it crosses is actually right here. And now it's going and the stock's trending kind of to the upside. So using a crossover will give you like a short duration and also a long duration picture. Because if you only do, here's a 200-day moving average or 200 bar moving average. If you do only a short duration one, it doesn't give you the whole bigger picture. Sometimes it reacts a little too quick. So now I've got short-term price trends and longer-term price trends. And when they cross over, it can kind of give you a nice insight of where to maybe get into the trade when it crosses over. And this is how a lot of people use them, is when it crosses over in these zones, that might be an entry point. And then when it crosses back, that might be an exit point. And of course, you could tweak that to your own benefit. Tip number 2 is color code your bars for a clear entry and exit. So here we've got kind of 2 moving averages right here. And what you can do, and I'm just going to hide one for a minute, and that way just again to simplify things. What you can do is actually color code your bars. And in this case, I can go in this program and color code them pretty quickly because again, I want to get rid of the clutter. And I'm going to go ahead and color code anything above the 150 a moving average. So, and I'll switch this back to 150. So now what you'll be able to see clearly is anytime the bar is white, that could be an entry signal, because again, I'm just trying to make cleaner decisions, because the goal is to really use these things to trade better. So here is a white bar, that could be an entry point. Then I stay in the trade, okay, stay in the trade, stay in the trade, stay in the trade. And then when I see, let's say, 2 bars that are not white, I'm out. Okay, there's 1, there's 2, I'm out. White bar, when I see 2 or 3 bars that are above it, nope, 1 bar. 2 bars, nope. Okay, 1 bar, nope, not yet. Okay, 1 bar, 2 bar, 3 bar, get in the 3rd bar, and then you're out. Okay, 3 bars, that was a loss. Okay, again, 3 bars, you could get in, maybe earnings, probably avoid it. 3 bars, again, get out. So you have some losing signals here. And then again, boom, boom, loss, loss, okay? And then they might have another signal here coming up later. So point being is when you're doing the losses, you might have some smaller losses there, but you're trying to catch trends that are, longer scope. And you can apply this to any stock chart now where, hey, you get into the stock, you ride the wave. But there are times when there is some chop, like over here, and you had chop where it's moving sideways and it's getting there, okay? Whereas over here, it looks pretty good. And then you had a nice trend there. All right, so tip number 3 here is know your strategy, which is, are you coming back to the moving average or breaking out? See, there's 2 different ways to kind of trade moving averages. One is to go ahead and look at stocks that can either break out and go away, or they can come back to the average. So when they're stretched far, they can come back into that average because the average is there. And the average is kind of more of a true price. So for a lot of people, what they're doing is they're trying to use the trend and trade above the moving average. But you could actually go ahead and say, hey, the price is stretched. It'll probably come back to the average. Now, the average is trending, but when you get stretched points, like even here, you can come back to that average. So you see how that's working out? When we get far away, we come back. When we get far away, we come back, okay? For a lot of other people, they're looking for a breakout away from the average. So know which strategy you have or what strategy you want to use, and then employ it properly, okay? So again, you had one that stock stretched, and it's coming back a bit. It's trying, it didn't do it, but the stock is strong. It's coming back a bit. So anyway, understand how you want to use those moving averages. And then the final tip I'll give you is use Fibonacci numbers as your moving averages. So for a lot of people, they have certain common moving averages numbers in there, which is kind of like a 20-day, which is a month of trading. People use like a 5, 8, 13. Here's kind of the most common ones as well that they'll have is 50, 100-day, 200, 10, 20, 50. But see right here, some traders use Fibonacci numbers right here. So this I find actually works quite well. I'll show you on my charts here. Here's my charts. Let me see here. The 3 times vertical that I have. I'll just do it this way. And what you'll see is I have moving averages right there. They're very subtle. It's hard to see because I kind of blur them out a little bit. But I have a 10, 21, 34, 55, 89. There's a 200 in there. And then there's another one that's a little bit kind of different. If based on volume, color coded, there's a dot in there that kind of goes in there. So anyway, so I have a handful of moving averages. And one of the other things that I do is just color code some of those things. So anyway, point being is if you use Fibonacci levels, it stretches those moving averages and you kind of see like, hey, are you having a spider web that's kind of moving right here, or is it messy? So if I look at this chart, you can see over here, it's clean. Over here, it's messy. So what I'm trying to find is really find a clean spot. So if I look here, here it is. Here's a lot of clean spots, whereas here's a messy spot. Okay, again, messy spot. Okay, and this is kind of one way of doing it. So anyway, I hope that helps in giving you a few different tips on looking at moving averages. Definitely check out some of the things we have on our website. There's a lot of great freebies and PDFs and downloads that you can take a look at. Links are in the description below. If you're on our website, even better. Feel free to book a free one-on-one coaching session for 20 minutes, and I'll help you out to see where do you go, how do you get started, and that way we can go ahead and kind of give you a learning path accordingly. So anyways, thanks again. Enjoy the rest of the week ahead, and I'll see you next time.